we are now going to dive into really the meat of financial reporting, and that begins with something called the accounting equation. And this is, again, really at the heart of all accounting, and that is assets equal liabilities plus equity. And these words may mean absolutely nothing to you, but hopefully they will soon. Assets are the things we own as a company. And I say we, I shouldn't, not we as an individual when we're talking about financial reporting, but they are the things the company owns. Liabilities are things that the company owes. And equity represents the investments or any money left over. If we were to take all of our assets, sell them all, and pay all our debts with them, hopefully we would have money left over. And what we have left over is our equity, and that would be what the owners could then take and move on with. Now, within equity, there's sort of an umbrella, and occasionally I get a little corny, and I will actually sort of open an umbrella to give that visual because people don't generally forget it once I've done that. And within equity, you've got four we'll call them sub-accounts. We've got our owner's capital, which is the investments made by the owner. Those are reduced by owner withdrawals, which is the money that the owner may have taken out. We have revenues, which is what the company has earned, and the expenses, which are the costs that the company has incurred earning the revenues. And those four things live under the umbrella of owner's equity. So we're going to start with transactions, and the first place that a company starts when it opens up is it's got to start with some money. So generally, you're looking at an initial investment from an owner. And in this case, we have Chaz Taylor, who's investing $30,000 in cash in a new business named Fast Forward. Fast Forward's going to be a proprietorship, so it's just going to be Chaz involved. And so the accounts that we have involved here are cash, because that's what Chaz is going to give, is $30,000 in cash. And we are going to record that in the equity account called C. Taylor Capital. Now, note these little up arrows here. And this will make a little bit more sense when we start talking about debits and credits later. But the balance in our cash account will go up as a result of the company having received this cash from Chaz. The balance in Chaz's equity account will also go up as a result of Chaz getting equity in exchange for his investment. And here's what this looks like. So remember, assets are things that we own. We now own Chaz's $30,000 because he invested it in the company. And then there's this little equal sign here. And C. Taylor Capital now has $30,000 in it. And our accounting equation is true. Our asset side, which is down at the bottom in green, equals our liabilities plus owner's equity, although right now we don't yet have any liabilities. So now the company's going to start doing some stuff. And it's going to purchase supplies for $2,500 in cash. So probably not a shock. As a result of this transaction, our cash is going to go down by $2,500. But remember, we've got this equal sign, and not all transactions take place on opposite sides of the equal sign. Sometimes you will see transactions that only occur on one side of the equal sign, and this is an example. So supplies is also an asset, things we own. And as a result of having made this purchase, our supplies have now increased as a result of making this purchase. So we have less cash, more supplies. And so let's look at how this looks in context of the accounting equation. Now we see here our first initial transaction is still here, but now we see that our cash has been reduced. So we got cash down here of all we have left now is $27,500, but we have these supplies. So between the two, we still have $30,000 in our cash account, or excuse me, in our assets, and nothing happened on the right side of the equal sign. So the C. Taylor capital account is still there, and our accounting equation still holds true. All right, so now we're going to purchase some equipment for cash. And what you want to be starting to get in the habit of doing is starting to think about what accounts are going to be impacted. Before you start to think about whether they go up or down, the first step is, okay, what accounts are being impacted? Well, we see cash, so that's a big tip. And how about equipment? I think you're right. So we've got fast forward purchased equipment for $26,000 in cash. So do we have more cash or less cash as a result of having bought this equipment? Hopefully you recognize that our cash went down. But what happened to our equipment? Do we have more equipment or less equipment as a result of having bought this? Well, hopefully, yes, we have more. Now let's look at this in relation to the accounting equation. Once again, you see that both sides of this transaction landed on the same side of the equal sign. So we've got cash that went down by $26,000. Now we've only got $1,500 in cash left over. And we still have our supplies, but now we have the $26,000 in equipment, still keeping us at that $30,000 amount for assets in total. And again, still haven't done anything on the right side of the equal sign, so that still remains at $30,000. Now we're going to buy some supplies on credit. So a slight twist. Well, we know we're going to have supplies impacted. We know that, but what would be impacted when we buy something on credit? Because we're not going to use cash. Not at least at this point. So we're going to purchase $7,100 on credit. So our supplies are going to go up, and now we're going to owe some money. We're going to have a liability, and that's going to be called accounts payable. And that liability, the balance in that liability account is going to go up as a result of having made that purchase. Remember, our cash hasn't been touched yet. We just bought the supplies and owe the money. So now we're going to see how that impacts both sides of the equal sign. Well, our supplies went up, so now we got $9,600 in supplies here, and total assets of, $37,100. We have that accounts payable total now living on the right side of the equal sign, and when we add that to our owner's equity, that also equals $37,100. Lo and behold, our equation still holds true and we are in balance. Okay, so now we are going to provide some services for cash. Okay, so if I'm thinking about accounts now, cash, certainly, and services. Wonder what we're going to call that. Not sure what we do. Oh, we have consulting services. Okay. And so we provided consulting services and got $4,200 in cash immediately. So our cash obviously went up by $4,200, and revenue also went up by $4,200. And remember, revenue lives under that equity umbrella that I talked about before we started jumping into these transactions. So hopefully you will not be surprised to see that revenue landing, there we go, under the equity heading on our little spreadsheet here. Now we have $4,200 more than we did before we performed that service. So our cash went up by, it's now a total of $41,300. And our revenue also caused the right side of the equal sign to go up. We are still in balance at $41,300. Okay, well, the time has come that we have some expenses we have to pay for. So again, cash, okay, now we've got expenses. And it's rent of $1,000 and salary of $700 to its employees. So we got some cash going out here. So our cash is going down. And we have expenses, but we have two different kinds of expenses because we don't want to lump all our expenses together into one category. We want to know what got spent on what each accounting period. So our rent expense went, and this can be a little confusing. We incurred rent expense, so what we're going to record is that we have now more rent expense and a salaries expense. Now, expenses, like revenue, live under that equity umbrella, which we will see. And often this is confusing for people because when the balance in the expense accounts, when we incur expenses, the balance goes up. And I think people get confused by that. They're like, well, I don't understand. If the balance in the revenue account went up, then how could the expenses go up? But it actually decreases total owner's equity. And as we get further down into this, you'll see how these things start to fit together. So, but quite often you'll say, hey, but shouldn't expenses offset revenue? And the answer is yes, and we'll get to that. But right now we're going to record increases in the expense accounts for both of those items. And so if you think about a little minus sign between that revenue and expenses, maybe it'll make a little bit more sense. But our accounting equation holds true. And so what have we done now? We provided services and facilities for credit. So we got some revenue coming in and people that are going to owe us some money. So Fast Forward provided consulting services of $1,600 and rents facilities for $300 to a customer for credit. So we got no cash as a result of this. But now we have to, this accounts receivable, this is where customers owe us. And this is a concept that I think students get confused about because we have accounts receivable and accounts payable. Accounts payable is when we owe, when we're going to have to pay at some later point. Accounts receivable is when somebody owes us and we are going to be receiving money at some point. And hopefully that will help you to kind of keep those straight. And we have two kinds of revenue here. We've got consulting revenue and then we have rental revenue. And so these are all increases as a result of this transaction. And if we look at this in our little spreadsheet format, you will see that we have total accounts receivable of $1,900 as a result of both of those transactions. And then over on the revenue side, they're broken down and into their own separate categories, because like expenses, we want to break down our revenue sources because we want to know where our money is coming from. Our investors and creditors want to know those things. All right, so now somebody's paid us. Well, this is excellent. And they tell us here, we got cash and accounts receivable is impacted. Well, as a result of getting this cash, so the last transaction, transaction 8, we got paid for the whole thing, for the consulting and the rent. Apparently it was the same client. So we have now cash as a result of having been paid. And what happened to our accounts receivable? Well, somebody's paid us, so now we want to give them credit for that. And so we're going to subtract that from our accounts receivable balance, because that money's no longer owed to us because now we have it in the form of cash. And here we are on our spreadsheet, and we can see again this last transaction, the payment, both of those occurred on the left side, on the asset side of the equal sign. And so that we had nothing impacting the right side of the equal sign, so we have $41,500 on both sides, and we remain in balance. We have transaction 10. Now we're dealing with payment. Well, who's paying? Us or somebody else? Well, it's an accounts payable. That's something we owe and have to pay. So we are going to be doing the payment, and what are we going to pay with? Cashola. Okay. So we're going to pay $900 as part of our payment for the supplies we bought back in transaction 4. So what's going to happen to our cash? It's going to go down by that $900. And then we're going to owe $900 less than we did a minute ago. So the balance in our payable account is going to go down as well. And here's what that looks like on the spreadsheet. We've got our payment from the cash, and then the reduction in our liability, and then we are in balance. Now we've got withdrawal of cash by our owner. So again, I see that word cash keeps coming back. And so because the owner's going to take some cash out, I bet we're going to have less cash after this. It's going to take $200 for personal use. And so sure enough, we're going to have cash as a result. Now, C. Taylor withdrawal. This is going to be sort of odd. We don't take the money out of his initial investment account. What we're going to do is start a separate account to keep track of how much money he has taken out. So he's going to have his own separate account for what he invested and a separate account for what he takes out. Those will both live under the same equity umbrella. But in the same way that expenses reduce revenue, also under that umbrella, the withdrawals are going to reduce how much C. Taylor overall has in equity. And let's see how that looks here. Okay, so we've got a $200 in cash that was taken out, and you see now we have this C. Taylor withdrawal, which is a negative, just like we had negatives on our expenses there. And that leaves us in balance. And now we're going to just see an overall summary. This, let's try and move me here. Okay. So this is in a snapshot, I should say, I guess, the 11 transactions we just went through. Now, notice at the bottom of each column is a balance. So at the end of this, we had $4,800 left in cash. Our accounts receivable, we had collected all of that, so that's down to nothing. I don't think we used any supplies, so we still have $9,600 in supplies. We still have our equipment. And now moving on to the liabilities, we paid some of our liabilities, and so we still owe $6,200. Mr. Taylor has $30,000 in his capital account, but again, less $2,000 in withdrawals. And then also under the umbrella of the owner's equity, we have the total revenue that we earned minus the total expenses that we had. And I'm going to stop here and move on to the next video for basic financial statement preparation.